Good afternoon, everyone. Welcome to our first 2026 World Stars Global Equity webinar. Thank you for your continued confidence, trust, and interest in our firm. We value these very much and take them seriously. I'm joined today by our CIO, Chris Rosbach. Our goal is to update you on our World Star strategy and discuss key topics of interest. We look forward to hearing any questions you have and the discussion after Chris's update. As always, we begin with a reminder of who we are and our investment philosophy. We are an independent asset manager with $2.6 billion of assets under management on behalf of institutions, endowments, wealth managers, trustees, and families, 20% of which on behalf of my family, the partners of the firm, and employees of the firm. We believe this provides our clients with a powerful alignment of interest. We manage 4 high conviction investment strategies on behalf of long-term investors based on fundamental research with a core focus on quality. Our sole mission as a firm is to deliver strong long-term returns on behalf of all our investors in a disciplined, repeatable, and rigorous manner. Our flagship investment strategy, World Stars Global Equity, represents $2.1 billion of assets under management, of which $452 million sits in our Luxembourg UCITS fund and another $609 million in our Delaware Limited Partnership Fund, which is available to eligible US investors. The World Star strategy is a concentrated, high active share, low turnover, quality global stock strategy, which has delivered 13.6% per annum net of fees in US dollars and 14.2% per annum in British pounds for the past 10 years, with controlled levels of risk. Gross of fees, this equates to about 100 basis points per annum of excess return. This performance builds on the quality of our investment proposition, the stability of our investment team, the repeatability of our institutional investment process, and World Star's available investment capacity. As many of you will have heard, quality is for us the defining condition for us to invest in the company. We define quality companies as those with strong and sustainable market positions, operating in good and growing industries, led by great management teams with strong track records of value creation and good corporate governance, and strong balance sheets to weather any type of adversity. We scrutinize those criteria through deep qualitative and quantitative analysis in a disciplined manner, making this the cornerstone of our investment process. If a company does not fulfill this criteria, we will just not invest. And that at any price. Quality always comes first. The key reason for that is that quality companies not only endure in uncertain and volatile environments, they get stronger, allowing us to protect and to compound capital for the long term. Before I turn over to Chris, I would like to mention that we are very excited for Chris to have been invited to join the Barron's Roundtable. It was a gathering of top global investors coming together in New York at the beginning of every year to discuss markets, opportunities, risks, and individual stocks. It's a great honor to be included, and it's a reflection of the achievement of our team and of the strong investment track record we have built over the years. Chris, over to you.
Thank you, Jerome, and welcome everyone. We're certainly off to an interesting start on the global stage. Let's begin by looking at performance. As you can see, 2025 was a strong year for us in absolute terms. The World Stars Global Equity strategy was up 13.7% after fees and 14.8% before fees, both measured in US dollars. Over the last 10 years, we've continued to deliver results that are consistent with our objectives, generating strong positive absolute returns and outperforming the MSCI World both before and after fees. However, very clearly, underperformance versus the MSCI World in 2025, and frankly over the last 12 to 18 months, has been pronounced. You can see that in the year-to-date comparison, where the MSCI World was up 21.1%, but you can also see it to a lesser extent in the 3 and 5-year numbers. The reason is both due to companies we own and to ones we don't. The market environment has favored companies that do not fulfill the quality criteria that we apply. There have been strong rallies in a number of those stocks, often over very short periods of time. As I go through the portfolio, I'll explain why we believe our portfolio remains well positioned despite this headwind. We believe that this will be another solid year for the companies we own. In a market that is more concentrated, more fully priced, and increasingly driven by a narrow group of stocks, stock selection becomes even more important. So as a reminder, our focus remains on owning high-quality companies that can grow in this environment that we can buy at reasonable or attractive valuations. We believe this approach can deliver strong absolute returns over time and, importantly, also strong relative returns as market leadership evolves. Our quality framework naturally leads us towards certain sectors and away from others. We invest in forward-looking companies that create solutions and drive disruption, rather than those being disrupted. This leads us towards areas such as digital transformation, consumer, healthcare, and industrials, which together make up the majority of our portfolio. We deliberately avoid balance sheet-driven financials, regulated businesses such as utilities, and capital or resource-intensive industries. These sectors face structural challenges, including disruption, regulation, significant capital requirements, high fixed cost, and pronounced cyclicality. Our objective is to own companies that can compound value over long periods and that have a clear runway over a 5 to 10-year investment horizon or longer. So let's turn to the next page. Turning back to the numbers for the calendar year 2025, you can see an underperformance of 6.8% relative to the MSCI World, along with the key sources of that result. This chart shows the attribution of returns for the year by GIC sector. You can see that one of the most significant detractors was financials. Our financial exposure is limited to MasterCard and ICE, a payments platform and an exchange. In 2025, it was the banks that rallied very strongly, in part from depressed valuation levels following a difficult period. That rally has taken many of those stocks to levels where we believe they're now fully valued. Materials was another headwind. Our exposure in this sector includes companies such as Givaudan, which is a leader in flavors and fragrances. However, the rally within the materials sector was driven primarily by resource companies. Those are not areas where we invest, given the capital intensity, the cyclicality, and the long-term structural challenges. In industrials, we have an overweight, which we're happy about. Some of our best performing stocks have been industrials, like Eaton and Amphenol that we've talked about. However, the industrial stocks that performed best this year were more capital-intensive businesses, particularly in defense, and especially in Europe. We believe many of those stocks are trading at valuation levels that are not sustainable over the long term, which is the reason why we did not participate to the same extent. And then energy was also a source of underperformance last year, although the impact was less pronounced given what happened later in 2025. So much for the kind of companies we do not own. We do own consumer companies, and consumer staples continue to be a significant source of underperformance. This reflects the delayed impact of the pandemic, the squeeze on consumers from higher interest rates and inflation, and the uncertainty created by US policy. In addition, our consumer exposure is primarily in European companies, Nestle, L'Oreal, LVMH, Diageo, and EssilorLuxottica, which we like better than their US counterparts. However, these companies generate between 25 and 45% of their revenues in the United States, and the US dollar has negatively impacted the translation of those results into euros, Swiss francs, and pounds. But despite this, we continue to believe that consumer staples is one of the most attractively valued areas of the market. We see very significant opportunities in the companies we own, and in fact increased some positions during the fourth quarter. There were also areas of positive stock selection. In information technology, for example, we're not overweight, despite NVIDIA being our largest position, and ASML having performed very well. Overall, this picture reflects a period of meaningful market underperformance, driven by a rally in stocks that do not meet our quality criteria. History suggests that quality and patience are ultimately rewarded. So, turning to the active return decomposition, the portfolio has an active share of approximately 84%. When we look at factor returns and selection effects over the past 10 years, the picture is quite striking. Until recently, factor returns were largely neutral. Virtually all of the excess returns we generated came from stock selection, the fundamental work we do on individual companies. More recently, factor returns have moved meaningfully into negative territory, driven by the rally in value-oriented sectors, such as financials, energy materials, and parts of industrials we talked about. At the same time, our aggregate stock selection has remained strong and has, in fact, improved. It's the factor environment that has driven total active return lower. Thus, this clearly identifies the issue. We continue to assess exposures carefully and believe the portfolio is well positioned to benefit both from stock selection and from factor returns when these trends reverse. So turning to the next page, one of the reasons for our confidence is the WorldStar's Global Equity Strategy's long-term record. Looking at rolling 5-year periods since its inception, we've outperformed the MSCI World in nearly 80% of the cases. That reinforces our belief that disciplined, fundamental analysis and patience are rewarded over time. From a statistical perspective, this recent period appears to be an outlier. In our view, this is an attractive time to invest in a portfolio like ours. So let me now turn to what we've been doing inside the portfolio. As you know, we take a long-term approach with a clear and consistent, repeatable investment process, as Jerome said, and an investment horizon of 5 to 10 years. Portfolio turnover is consistent with that approach, typically around 10 to 15%, which is exactly what you would expect for strategy with that time horizon. At the end of November, following a detailed review of both fundamentals and valuations, we made several changes. I want to highlight some of the most important ones. We trimmed NVIDIA, reducing the position from close to our 10% limit to 7.7%. This was primarily for risk management reasons, but it also reflected lower upside to our discounted cash flow valuation at the current prices. NVIDIA remains our largest position, and as we said at the Barron's Roundtable, we remain very positive on AI and believe we're still at a very early stage of realizing its benefits. We also trimmed 2 industrial holdings, Amphenol and Eaton, both of which had performed extremely well last year. Amphenol rose nearly 100% in 2025. We reduced the position by 1.5% to 4.4%. Since our initial purchase in 2020, it has delivered a 40% compound annual growth rate. We remain very constructive on the business, but we see more limited valuation upside at current levels and wanted to reallocate some capital. Similarly, we reduced Eaton by 70 basis points to 4.2%. Eaton is a global leader in power management and remains fundamentally attractive, but the valuation is well above its 5 to 10 year historical average. So we redeployed that capital in several ways. We initiated a new position in Nike, which I'll discuss in more detail shortly. We also added to existing positions in American Tower, L'Oreal, Honeywell, among others. American Tower, the wireless infrastructure company, is attractively valued and should benefit from the interest rate outlook in the United States. L'Oreal, the global leader in cosmetics and hair care, continues to trade at what we believe is an attractive valuation. Honeywell is undergoing corporate change and trades at a meaningfully lower valuation than peers such as Amphenol and Eaton. In addition, we reduced exposure to some digital companies, we exited Pernod, and we increased our position in Diageo, refocusing our exposure within the spirits industry on what we believe is the global leader. So now let me turn to a few individual companies, and I'll start with ASML. ASML is Europe's largest company with a market cap of about 500 billion euros. It's the world leader in semiconductor equipment for the production of lithography, used in the production of semiconductors. They're the leader in extreme ultraviolet or EUV technology, which is at the cutting edge of what is necessary in order to produce the advanced chips and GPUs that NVIDIA is using to power the computing capacity that we need for AI. It is a business that has a long lead time in terms of its business and a backlog that typically stretches over 18 months. It's practically unique in terms of its competitive position. And we think it is very attractively positioned for the amount of investment that is necessary to fuel this computing capacity. It has about 35% of its revenues in EUV. It has another 35% roughly in the more mature deep EUV machines. which are benefiting from the ongoing demand for semiconductor content as the world becomes more electrified. But we're at a point now where, as a result of underinvestment, there's an ongoing need for the higher capacity lithography machines. And there's also a demand for the lithography equipment that generates more straightforward semiconductors in memory and other areas. The aggregate investment that is going into the industry is very significant. We estimate that industry wafer fab equipment spend of $110 billion in 2025, but that it can grow to over 150 billion in 2027. You can see that we first bought it in January of 2023. It did very well. Then it declined in sympathy with some of the other trading that is taking place because of geopolitical uncertainty and delays in some of the capex. But as the market has begun to realize the importance of what they do, this investment will come through. You can see that the stock has started to move. It's up, I think, almost 35% in 2025, and it's up a further 20% this year in 2026 alone. We've had ongoing announcements of increasing capex in fabrication facilities or fabs. ASML is benefiting from the need for investment in fabs by TSMC, who themselves last week announced a 30% increase in capex spend in 2026 compared to 2025, with the vast majority of the spend going to advanced logic and also other producers in Taiwan, Japan, and the United States. Some of this in response to the policies of the Trump administration, some of it also in Europe. And as this capex is now coming through, we think that the company is extremely attractively positioned to take advantage of it. While it's clearly trading at a premium multiple, we think, looking at our discounted cash flow valuation, that it still has very significant upside. And I think if you look at the share price chart, you can see that in businesses like this, a degree of patience is required to generate strong long-term returns. The CAGR is very attractive, but you can see it's a stock that is somewhat volatile and it trades accordingly. So the next stock I want to talk about is Nike, which we added to the portfolio. It has a market cap of about $96 billion. It's the global leader in athletic footwear and in sportswear with a very significant market share. The global sportswear market is expected to grow at about 6% CAGR over the next several years and exceed $500 billion in sales. While it has gone through a difficult time, we believe it's very well positioned. Nike, like other companies, benefited from the pandemic and then suffered some of the after effects, as well as some of the actions that management took. In particular, they switched their focus from supplying major retailers with the best products to selling them through own stores with direct sales, reaching a high of 44% in 2024 versus 32% pre-pandemic. That worked very well during the pandemic. It was in line with the selective distribution that other higher-end brand companies, including LVMH, have been doing. But what they did is that they also left open shelf space for other competitors. We all know some of them, like Hoka and others, that retailers were effectively happy to fill the space with a more innovative product that they provided. And that came to hurt Nike. Nike also over-relied on some of its classic franchises, like Air Jordan 1, Air Force 1, and especially Nike Dunks. And they cut back on product innovation. Classics footwear franchises are on track to decline by 4 billion since peak levels, and now represent just over 20% of total sales. There's now a turnaround taking place since October 2024, when Elliott Hill started as CEO. Hill is a veteran of the business who has returned to Nike and we believe has a very credible plan to turn the business around. He's supported by Tim Cook, the CEO of Apple, no less, and a Nike board member since 2005. In December, Elliott Hill and Tim Cook purchased Nike stock worth 1 million and 3 million respectively. With recent announcements of the leadership changes in Nike's EMEA and Greater China regions, we think there's now a very strong management team in place to lead this turnaround. It's around a number of issues. It's a refocus on the retailers. It's going back to the scale that they have, not just to innovate, but also to have sponsorships and to invest in branding and in advertising and promotion. And some of the new products are focused on performance. The innovation they're doing now on their running shoes, specifically the Pegasus and Vomero franchises, has had a strong response with over 20% growth in the past 2 quarters. And it demonstrates Nike's ability to innovate and to claw back some of the lost share. And while they've had issues, including in China, where the consumer spending has been under pressure from the measures that have been put in place to realign real estate markets, we believe that this year could be the transition year and that earnings and cash flow generation will more than double over the next several years, which is why we decided that this was a real opportunity to buy at these low valuations. So the next company is Roche, the Swiss pharmaceutical and diagnostics company. It has a market cap of about 283 billion Swiss francs. It's a business that's gone through a significant patent cliff, and like other diagnostics and medical device companies, had a significant roller coaster in terms of its performance during the pandemic. We believe that it's now very well positioned in terms of its pipeline to deliver significant growth. At the same time, in line with what's going on in other areas of the US economy, some of the Trump administration policies are pointing to a more stable and actually reasonably favorable environment, which has taken away some of the uncertainty. On the one hand, Roche has relatively low exposure to government purchasing in the US. So that is something that insulates it from some of the cost pressures that are taking on pace. And on the other hand, some of the measures that the US administration has been putting in place around agreements with the pharma industry are going to be beneficial. They've announced, along with other global companies, investment in the US, which I think is helpful. And at the same time, they have significant capacity for growth. And so we think that it also bodes well for the returns that they should be able to generate. The most important thing is that they've had some very significant pipeline successes. Giredestrant, which is a breast cancer drug, has had a very good readout from a recent study. It's one of the things that's helped the stock price to move, and we think that it has significant promise to become a multi-billion-dollar drug. Roche also has a number of other drugs and important indications that are going to come through. Just this morning, Roche announced positive phase 2 trial headline data for its obesity drug, CT388, which has the clinical profile in terms of weight loss and side effect very similar to Lilly's Zepbound. 2 phase 3 trials will be initiated this quarter for CT388. So we think the valuation is very attractive, and we see significant upside to discounted cash flow valuation. So finally, I want to talk about SAP. We bought the stock in June last year, so we've talked about it already a little bit. It's one of the stocks that we increased in December as part of the trading that we did. It's the global leader in enterprise resource planning, or ERP software, with a market cap of 240 billion euros. It's a German company that is absolutely instrumental to how companies can manage their data, value chain, purchasing, capital allocation, and many other functions. 99 of the largest 100 companies in the world run on SAP. One of the reasons why companies have been able to increase margins as much as they have, and why we think that is sustainable, is because of SAP. Nestle, the world's largest food company, took over 10 years from about 2003 to 2013 to implement SAP across its business. So even a global company like Nestle, which is one of the leaders in implementing this kind of ERP system, has only been able to manage its business for just over 10 years on a global basis. SAP is highly embedded, and importantly, it's been able to shift its model from individual license to recurring subscriptions, and it has been able to shift it from individual service to the cloud. You might think that would be obvious, but the move to the cloud has taken a long time because SAP is so embedded in the companies, and it is so important in terms of data security and integrity of their operations. So cloud is now over 50% of revenues, and we think it'll go to 80% by 2030. What we think is really important about SAP is the potential to be a major beneficiary of AI. They're in pole position to be able to take the data that they house for companies from their value chain and use it for those companies to train models to have better outcomes in terms of productivity, in terms of optimizing supply chains, and many other applications. It's part of the tremendous productivity increases we expect over the next 5, 10, and 25 years as AI gets implemented at scale in these large companies. The AI is only as good as the information that it trains on, and SAP is home to the most important operational information. Those companies that have the best data estates will benefit most from AI. Again, as we said at the Barron's Roundtable, the overall framework we have for AI is that the big data companies are the first ones to benefit, but it will take time for larger companies that don't yet have the data available, that don't have the computing capacity, that don't have the applications, and that don't have the people to realize the full benefit. It's SAP that is going to be one of the businesses that is going to be instrumental in enabling them to do that. We think that the new AI models that have been trained on the more recent NVIDIA Blackwell will be astonishing in terms of performance, and that it will be able to solve for enterprise needs. The too common criticism is that the AI is not perfect yet for mission-critical enterprise, but we think that this is just around the corner. SAP is in pole position to incorporate and expand AI across the enterprise. It's one of the reasons why we think that the large global companies are going to be the ones that are going to be benefiting, because they have the scale to be able to make those very significant investments over the next periods. The share price chart shows that it basically has done well, but then it flatlined. The valuation that you can see here is showing that it's trading at what we think is a reasonable multiple for the growth that we're expecting. Our discounted cash flow analysis has over 60% upside that we're looking for in this type of company. We believe it's a very, very attractive proposition. We first bought it in July, and as I said, we increased the position in December. So let me now conclude with our outlook. As Charlie Munger once said, micro is what we do, macro is what we put up with. And there's been a lot of macro to put up with. Like we've expected, the US and global economies have remained resilient. Inflation is moderated, employment has held up, and activity has been solid. While uncertainty remains elevated, particularly around foreign policy, the area the US president can affect most directly, the overall outlook is constructive. We said last year that in the US, what must happen will, and what can't happen won't. That has turned out to be true in many important areas. We continue to believe that economic constraints matter. The economy, markets, and institutions impose limits, and we've already seen moderation in areas such as trade policy and Fed leadership. The economy is a top issue for voters, and with midterm elections later this year, we expect President Trump and his administration to increase focus on domestic economic stability. We invest in companies, not markets or politics, but the uncertainty has clearly held back everyone from the largest company to the individual, and greater visibility would clearly be supportive. There's also clear reasons for optimism. Overall economic growth remains solid, inflation is moderating, and the US Fed is likely to remain supportive regardless of who gets appointed as chair and whether they cut rates or not. Investment in AI continues at scale. Across industries, companies are pursuing productivity and revenue opportunities. We also see potential for recovery in software and industrial investment, and for consumer spending to stabilize. I've been to the US and to Japan at the beginning of the year, and I've seen many examples for the innovation and investment that is taking place. Taken together, a stabilizing macro backdrop, solid economic fundamentals, and company-specific growth, we believe that the environment is supportive. We own businesses that can grow earnings and cash flows at high single to mid-teens rates over the next 5 years, and many at reasonable valuations. What's more, in consumer and healthcare, we see additional upside from valuation normalization. Just as performance shifted rapidly in favor of banks and energy last year, it can reverse just as quickly for consumer stocks. That's why we do not time markets, we focus on fundamentals. So we believe this is an extraordinary opportunity to buy great quality companies at good prices, and in some cases, great prices. In a market where index investing has become increasingly risky, stock selection matters more than ever.